All right, let's dive into something that sounds small but has a massive impact on global trade. Two little acronyms, FOB and CIF. If you're in any business that moves goods across borders, you've got to know this stuff. Understanding the difference isn't just important, it's absolutely crucial. Okay, let's start with a total nightmare scenario. Just imagine you've ordered $50,000 worth of inventory. You're waiting for it to arrive. Then you get that dreaded call. The container ship carrying your stuff, it sank in a storm. Everything's gone. Your heart just drops. But then the really big question hits you. Who is on the hook for that loss? Who's paying that bill? Well, the answer comes down to which one of those little three-letter acronyms was on your contract.
So to figure that out, we first need to get a handle on the foundation of this whole process, freight costs. It sounds simple, right? But trust me, the implications are huge.
Now, when you see a definition like this, all expenses to transport goods, it seems straightforward, but it's actually kind of complex. This isn't just the price for the boat ride. Nope. It covers everything. The trucking to get to the port, the loading, the insurance, the main voyage itself, and the unloading. It's the whole shebang from point A to point B. And how those costs get divided up? Well, that's what this is all about. And that brings us to the main event, decoding FOB and CIF. The best way to think about them is as the two main rules of the road for international shipping. They lay out exactly who is responsible for what and, this is the key part, when that responsibility officially changes hands. Here's the simplest way to wrap your head around it. With FOB, which stands for free on board, you, the buyer, take control of the shipment pretty early in the game. But with CIF, that's cost, insurance, and freight, the seller holds on to that responsibility for a lot longer. Let's really break down what that means in practice. Okay, let's zoom in on the FOB, or free on board. The key moment here, the magic moment really, is when the goods get loaded onto the ship. Just picture the rail of that giant cargo ship like it's a finish line. The second the seller's goods cross over that line and are safely on board, poof, just like that. The risk, the ownership, and the responsibility for all future costs, it all instantly transfers over to the buyer. The seller can wipe their hands clean, they're officially off the hook. Now, let's flip that completely and look at CIF, which is a totally different deal. With CIF, the seller is responsible for, well, pretty much everything. They handle the shipping cost, they get the insurance policy, and they make all the freight arrangements for the entire main journey, all the way until that vessel actually arrives at your destination port. The seller handles the whole trip, and the buyer only takes over once the ship is safely docked. You know, to really make this stick, let's make it super practical. We're going to imagine we have the exact same container of goods, and we're going to watch it take two different journeys across the ocean, side by side, one under FOB rules and the other under CIF rules. First up, the FOB journey. Okay, so the goods leave the warehouse, they get to the port, and now, step 2. This is it. This is the crucial moment. The instant those goods are loaded on board, that baton of responsibility is officially passed. So as that ship is crossing the ocean in step 3, that is the buyer's cargo. It's under the buyer's insurance, and it is 100% at the buyer's risk. Now look at the CIF journey. See the difference? Through steps 2 and 3, when the goods are getting loaded and while they're crossing the big wide ocean, the risk stays firmly with the seller. The seller is the one biting their nails worrying about storms or pirates. It's only at the very, very end, in step 4, when the ship has finally arrived at the destination port, that the risk finally transfers over to the buyer. And you know, this choice, it goes way beyond just logistics and shipping. This decision sends ripples right into a company's financial statements and its legal liability. It literally changes who owns the inventory on the balance sheet and who's going to have to call the lawyers if things go sideways. This table really just lays out the bottom line. So who pays the freight bill? With FOB, it's the buyer. With CIF, the seller pays. Who technically owns that inventory while it's floating on the water? A really big question for the accountants. With FOB, it's the buyer's asset. With CIF, it's still the seller's. And finally, let's go back to our lost shipment. Who has to file that insurance claim? With FOB, that terrible phone call is the buyer's responsibility. With CIF, it's the seller's problem to solve. So what this all really boils down to is that the choice between FOB and CIF, it's a fundamental strategic decision for any business. It's a calculated choice about risk, about control, and of course, about cost. And this quote says it perfectly. The choice isn't just about shipping cost. It's about who controls the cargo and who carries the risk. See, a buyer might choose FOB, even though it's more work, because they want to control the entire process. They want to pick their own freight company, negotiate their own rates, and manage their own insurance. But on the other hand, a seller might really push for CIF because it lets them bundle all those services together and maintain control until the very end. So, here's the thing. Neither one of these terms is just better than the other. It's always a trade-off. A seller might offer you what looks like a fantastic deal with CIF, but what that really means is you're handing them the keys to your supply chain for that entire journey. And that leads to the final question you should always be asking yourself. Is that potential cost saving worth giving up that much control? And that right there is a question every single business has to answer for itself.